Good morning, everyone. Am I audible? Can you hear me? Okay. Thank you so much for confirming. So, uh, last class we had discussed about introduction to financial management. So today we'll start with another concept of financial management, that is profit maximization as well as wealth maximization. Okay. So broadly, we can say there are two alternative objectives that a business firm can pursue. So when any business is managing its finance, it has two primary objectives. One is your profit maximization and second one is the wealth maximization. Okay, so let us understand what is profit maximization. So it is a term which denotes the maximum profit to be earned by an organization in a given period of time. So given period means you can take one accounting period, 1 year or one financial year. So within that period, how much profit earned by the firm it denotes. So whenever we are talking about profit, it simply indicates the quantum of earnings of a firm. What is the net earnings earned by a particular firm or particular company? Am I not audible? Someone is saying, sir, you are not audible. Can you hear me? Am I audible? Yes, yes. So, Shweta madam, you just check your connectivity. I think some technical issues at your end, not in my end. Okay. So anyway, so first concept is about profit maximization. Profit maximization means what? The firm has to maximize the profit. It has to earn the quantum of profit relating to a particular period. Particular period may be one accounting period or it may be one financial year. The profit maximization goal implies that the investment decision, financing decision, as well as the dividend decisions of the enterprise should be oriented to profit maximization. So last class we have already discussed about the key decisions to financial management. So broadly there are three key decisions. The first one is your investment decision, second one is financing decision, and third one is dividend policy decision. So these three decisions are the key decisions of the financial management. The profit maximization goal or the objective of the profit maximization implies that all these three decisions of the enterprise should be oriented to earn profit. To earn profit. Okay. So a profit maximization simply indicates the quantum of profit earned by a firm. Then what are the merits of profit maximization, or what are the advantages of profit maximization? You know, survival is the fittest. In order to survive in the marketplace, each and every firm needs to earn some amount of profit. Okay. So one of the merits of profit maximization is that it is one of the best criterion on decision making. Let's say you are the investor, you have some amount of money, you want to invest by way of purchasing equity shares, preference shares or debentures of that company. How will you take the decision? Simply you are looking at the earning capacity of the firm. Earning capacity means what is the amount of profit earned by the firms. Okay, so on the basis of the profit earning capacity, you are taking the decision where you are going to invest. So that's why you can say it is one of the best criterion on decision making. On the basis of the profit earning capacity or profit earnings ability, as a as an individual or as a part of the management or as an investor, you can take the decision that this company is performing better. Second one is about efficient allocation of resources. What are the availability resources are available for the farm? On the basis of that, if the farm will utilize all the resources, all the available resources to the fully extent, then it can able to earn maximum amount of profit. 100% plant utilization, 100% utilization of human resources, 100% utilization of other raw materials, physical resources, etc. So when the farm efficiently allocate its resources for taking various decisions by a firm, it ignores all the risk factors. So it is another drawback of profit maximization. It may tempt to make such decisions which may, in long run, proves disastrous. So if you look at the long run, so for long run, profit maximization concept can be treated as one of the most important aspects of wealth maximization. Capital is 10 lakh. Equity capital is 10 lakh. Now, these equity shares are traded in the marketplace. If the market value of the share will increase, automatically, if the market value of equity capital will also increase. When the market value of the equity capital will increase, we can say the market value of the firm is also increase in the marketplace. So the fundamental objective of wealth maximization is to maximize the market value of the firm share. Again, maximizes the net present value of a course of action to the shareholder. Maximizes the net present value of a course of action to the shareholder. That means, as a firm, you have to maximize the value of the shareholders. Who are the shareholders? Shareholders are the owners of the company. They have invested some amount of money in your company or in your firm. So your duty is to maximize the value of the share. Again, it accounts for the timing and risk of expected benefits. This wealth maximization concept always focus on the timing factor as well as the risk factor. What is the amount of risk or degree of risk involved in various decisions taken by the firm? It always consider in order to derive some expected benefits or bundle of benefits. So under wealth maximization concepts, what are the benefits received by the firm that can be measured in terms of cash flows? In terms of cash flows, let's say today you are investing some amount of money, in how many years or in how many series of years you are going to receive the cash. You are going to receive the cash. Today you are spending 1 lakh in a particular project. So in how many years you can able to receive cash, periodical cash flows. So as per wealth maximization concept, we can say benefits can be measured in terms of cash flows. In terms of cash flows. Okay. So then what are the merits of wealth maximization? The wealth maximization objectives takes care of all the stakeholders. What are the stakeholders? It may be shareholders, it may be debt holders, it may be lenders, or it may be workers or employees. So these all are the various stakeholders. The wealth maximization objectives takes care into shareholders' interests, lenders or creditors' interests, those who have already supplied some raw material, some goods, or some amount of money to the business. Again, it also takes care of the workers as well as the employees and staffs. How? It can give some perquisites, it can able to give some what you can say incentives. In this way, it can takes care of the employees or its human resources. It also ensures fair return to the shareholders, building up reserves for growth and expansions, ensuring financial discipline in the management. This wealth maximization concept always provide fair return to the shareholder. Fair, which are desirable, which are acceptable. Again, it also builds some amount of reserves. Why we need reserves? We need reserves for the growth, for the expansion, modernization, diversification of the business. Again, it ensures financial discipline in the management. That means the fund, what are the amount of fund available in the business that can be flow across the business to various parts of the business. So it takes care into 360 degree we can say, each and every part, every corner of the business. That's why wealth maximization concept is desirable. Again, it focuses on the long run. So in case of wealth maximization, the firm always focuses in the long run. It can plan for 10 years, 15 years, 20 years, like that. It takes into account the time value of money factor. it consider the time value of money. What are the amount it is going to receive in the near future? At the first year, what is the amount it is going to receive? At the second year, what is the amount it is going to receive? In the future years, what are the amount it is going to receive? That will be discounted with present value factor. That's why it consider time value of money factor. Again, it considers risk also. What are the amount of risk associated in various decisions of the business? It consider. Again, it maintains market price of the share of the organization. Always it focuses on how to increase the market price. So for increasing the market price in the marketplace, what are the indicators? So it always focuses on EPS, earning per share. It also focuses on how to take care of various stakeholders. Okay, so it recognizes the value of regular dividend payments also. Wealth maximization concept also consider the regular payment of dividend. So dividend will be paid to whom? Dividend will be paid to the equity holders or preference stockholders. Okay, so the firm will pay the regular amount of dividend to its shareholders as well as preference stockholders. So these all are merits of wealth maximization. Then what is the conflict between this profit maximization and wealth maximization? As we have already discussed both the concepts, so we can summarize the conflict between profit maximization as well as wealth maximization. The main objective of profit maximization is to earn large amount of profit, but the main objective of wealth maximization is to achieve the highest market value of common stock. Common stock means, try to remember, it is the equity capital, equity shares. So the main objective is to achieve the highest market value. How the firm can able to maximize the market value of the shares. Again, it emphasizes in short run. Profit maximization always focuses in short run, but wealth maximization focuses in long run. So if you are planning for profit, you can plan for a period of 1 year or 2 years like that. But if you are planning for wealth maximization, you have to plan for a long-term purpose for a period of 10 years, 15 years, 20 years like that. Again, profit maximization ignores time value of money concept, but wealth maximization consider time value of money concept. Profit maximization ignore risk and uncertainty. What are the risk and uncertainties associated with the business? It always ignores. It always focus how to earn profit. How to earn profit. That means how to increase the revenue, how to minimize the expenses, and how to earn the profit. But wealth maximization takes care about the risk and uncertainty. It always consider. It always recognize what are the amount of risk or uncertainties involved in the various decisions taken by the business. Again, it ignores the timing of return. Profit maximization ignores the timing of return. When you are going to get your return, it ignores. Simply it focus on how to increase the sales, how to increase the revenue, how to minimize the expenses. But wealth maximization always focuses on the timing of return. It always focuses on the market trends, market scenario. On the basis of the market scenario, it will declare the dividend. Again, it will what you can say, it will able to increase the EPS, earning per share. So these are the indicators so that the market value of the share can be increased in the marketplace. The demand of the share can increase in the marketplace where it is traded. Okay, so this is the conflict between profit maximization as well as wealth maximization. Okay, so now we are going to discuss about what is the basic difference between profit maximization and wealth maximization. So it works to increase the net income. Whenever we are talking about profit maximization, this concept works to increase the net income of the business. How to increase the net income? But wealth maximization always focus on how to increase the net present value of the firm. Net present value of the firm. So profit maximization is a vague concept. Why? Because it does not specify timing, risk factor, as well as the amount of risk involved. But wealth maximization is one of the clear concept. It specifies all required timing factor, risk factor, and the amount of risk involved. Again, profit maximization is owner centric. Owner centric means concerned about the owner's growth and net income. How to increase the owner's growth? Who are the owners? Shareholders are the owners. So how to increase the value of the owners? Okay, but wealth maximization is business centric. Why it is business centric? Because it concerned about all the stakeholders, all the interested parties involved in the business. It may be a customer, it may be the creditor, it may be the banker, or it may be the shareholders, investors, and others. So that's why you can say wealth maximization always business centric, but profit maximization is owner centric. So next one is a short run. Profit maximization focuses on short run. Only it cares about the short run gains, how the firm can earn some amount of profit in short run. But wealth maximization always focuses in long term, plans for long term gains. How the firm can increase its wealth over a period of 10 years, 15 years, 20 years, or 25 years, like this. So long term plans. But profit maximization ignores that risk, inflation, and time value of money. But wealth maximization accounts for risk, inflation factor, as well as time value of money concept. So this is another distinction between profit maximization and wealth maximization. Profit maximization is one of the traditional concept, but wealth maximization is the modern concept or new concept. So profit maximization is as it is traditional concept, it is old, not suitable for current business scenario. But in case of wealth maximization, we can say it is one of the modern concept, new concept. It is suitable for current business, recent business trends. So after comparing these two, someone is asking, sir, what is infection? Not infection, inflation. Can you please explain the time value of money again? Time value of money means what? When money passes through time, its value will increase. Let's say here I want to cite one example. There are two options. 1000 amount available to you. So 1000 amount, there are two options. The option number one is that right now you are going to receive 1000. Another second option is that you are going to receive 1000 after 1 year. As an investor or as an individual person, tell me which one will be suitable to you. Today, if you are going to receive 1000, or after 1 year, if you are going to receive 1000, which one will be suitable to you? Which one will be suitable to you? Obviously today. Very good. Obviously today. Today means what? If you are receiving today 1000, that is the present value. If you are receiving tomorrow, means after 1 year 1000, that is the future value. That is the future value. Okay, so what we are going to receive in our future, what is the present value of that amount today? After 1 year, if you are receiving 1000, the present value of that 1000 is not 1000 today. It is less than that. It is less than that. Why? This happens because of the time value of money concept. Time value of money concept. Okay. So we can summarize both the concept property maximization as well as the wealth maximization concept. We can say organization goal should be shareholders wealth maximization over profit maximization, because profit is a long term. Whenever you are doing business, or whenever any firm or any company is doing business, it always focus in the long run. Why? Because you are not doing the business like your color business at holy time or Rakhi business at Rakhi festival, like this, not seasonal business. So whenever you are doing the business, you are doing for a longer period of time. So how you can able to increase your wealth in a longer period of time, that should be the focus of the firm. That's why we can say the firm's goal should be shareholders wealth maximization rather than profit maximization. Is it clear? Is it clear, everyone? So next, let us see what is the role of Chief Financial Officer or CFO. Okay, So who is a chief financial officer? We can say the senior manager responsible for overseeing the financial activities of the entire company. What are the financial activities carried out by a particular firm or company? So it will look after all the activities. The CFO's duty includes financial planning. Financial planning means how to raise fund, where to procure fund, and how to procure fund. Again, monitoring the cash flows. What are the cash flows it is the firm is going to receive in the near future? It will monitor, it will watch, it will observe. So he or she analyzes the company's financial strength and weaknesses. What are the financial strength of the company and what are the financial weaknesses of the company? The CFO will analyze and suggest plans for improvement. If there are some weaknesses, then the CFO, Chief Financial Officer, will suggest some plans for improvement. Okay, the CFO is similar to a treasurer or controller in that he or she is responsible for overseeing the accounting and finance department. So the head of the accounting and finance department of any company or any firm is the CFO, Chief Financial Officer, because it will take the various decisions relating to financial planning as well as various financial activities. Okay, so these are the various roles to be played by the CFO, Chief Financial Officer. Raising of funds, how to raise the funds from the market. Again, understanding the capital market. Why it has to understand the capital market? Because the company's shares are going to be traded in the capital market, where long-term funds are traded, equity shares are traded, preference shares are traded. So that is the capital market. So the CFO should have the knowledge about the capital market also. Again, the CFO must plan for the profit, how to earn the profit in a long run, not in the short run. If you are planning for profit in the short run, then you are focusing on the profit maximization. That is your short-term goal. Why short-term goal? You have to exploit all of your resources so as to maximize the profit. But as a CFO of any firm or any company, you have to plan for the profit in a long run. Again, allocation of fund. The CFO has the duty to allocate the funds in various activities of the firm or various activities of the company. What are the various activities? What is the amount of fund to be allocated to the sales department, to the production department, to the HR department, to research and development department? Okay, so these are the various activities where the CFO can allocate some amount of fund. Again, dispersal of profits. So after earning of the profit by a firm, the CFO has to segregate the profits. How to segregate the profit or appropriation of profit, we can say. How to segregate the profit? So it can take the decision about how much should be distributed as dividend, how much should be kept as retained earnings, how much should be utilized in the business, etc. So it will take the decision about the dispersal of profit. Again, financial control. Why financial control? Because since it is the head of the finance department of any organization, so the CFO's role is to monitor, is to closely watch all the financial activities of the firm. Otherwise, there may be chance of siphoning of funds in various activities, so that the firm may not be able to achieve its target, its objective. That's why the CFO has to take care of the financial control of the firm. So these are the various roles played by the CFOs, Chief Financial Officer of a company or Chief Financial Officer of the firm. Okay, so this is all about your profit maximization as well as profit maximization, wealth maximization, as well as the role of CFO, Chief Financial Officer of a firm. Is it clear? So this is all about your unit 1. So briefly we have discussed the introduction to financial management. There we have already covered the concept, meaning and definition of financial management, the objective of financial management, nature and characteristics of financial management, role of financial management. Again, we have also discussed about what are the various approaches in financial management and what are the key decisions to financial management. Along with today we have already covered the profit maximization and wealth maximization concept and role of CFO. Basudev Sahu sir is asking, sir, again dispersal of profit. Dispersal of profit means segregation of profit. Let's say the firm is earning 100 rupees of profit. So that is the net income of the firm. So how 100 rupees can be distributed? How much to be distributed as dividend, how much to be kept as retained earnings, and how much to be utilized in the current business. This is simply, you can say, distribution of profit. How to distribute the profits? After the profit will be earned by a particular firm, how the profit can be distributed? So that decisions can be taken by Chief Financial Officer. Is it clear? Okay. So let us capital investment decision. So capital investment decision is coming under capital budgeting decision of a firm. Capital budgeting decision of a firm. So whenever we are using the word capital, try to remember uh, it involves large amount of fund. Capital means what? Simply we can say it involves large amount of fund. Okay. Then what is budgeting? Budgeting means it is the process through which the firm can plan for its capital investments. Capital investment. So what are the capital investments? Let's say one firm is taking the decision about for implementation of new projects. Implementation of new project. So for implementation of new project, it involves large amount of fund. That's why the firm needs to take capital budgeting decision. Capital budgeting decision. So look here, this is the definition of budget. You know, budget means what? Simply you can say estimates. In our day-to-day life also we are making the budget. We are sometimes making our family budget. At the end of the month, again we are planning what will be the amount of ration, what will be the amount of house rent, and what will be the amount of clothing, and what will be the amount of other luxury needs. Okay, so these are some estimates. If we are also planning for any picnic or any feast, again you are also making some estimates. What will be the total number of people available in your feast? On the basis of that, you are again allocating where will be your venue, and what will be the menu, and what will be the timing. On the basis of that, we are making some estimates. Okay, so this estimate is known as budget. So from budget, from the word budget, we are defining the word budgeting. Budgeting means what? The process of preparing a budget. How we are preparing the budget, that is known as budgeting. So budgeting, simply we can say budget is a management tool for planning and controlling future activities. What are the activities to be performed by a firm or by a business in the near future? The management has to plan for it. On the basis of its the management's planning, it can control the entire activities in order to accomplish its objectives. Okay, so here we can also use some financial buzzwords relating to budget, like your plan for saving, or we can say borrowing or spending. Let's say you are going to construct your house. For construction of your house, you are planning what will be the entire expenditure for construction of the house. Let's say 30 lakhs. So you can say 30 lakhs is your budget. That means you are going to spend 30 lakhs. So sometimes we are using also financial buzzwords like a plan for saving, borrowing, or spending. So budget simply indicates a pre-planned activity expressed in quantitative terms. Pre-planned activities. What we are going to perform in our near future, before that we have to plan. Before that we have to plan. And what are the items there will be in the budget that must be expressed in quantitative terms. Quantitative terms. For construction of building, again you can say what will be the labor cost, what will be the raw material cost, and what will be the other cost. Okay, so these are the various items. These items must be explained in quantitative terms. Okay, someone is asking something, I think. Dear sir, give a example which we understand. Which example? Which example? I have already given the example relating to budget. Let's say your family budget. For your family budget, what are the items in your family budget? It may be your food, it may be your clothing, it may be your shelter. Shelter means if you are taking or if you are residing in a rented house, what will the rent? So relating to fooding, what is the fooding? What is the cost of ration? What is the cost of vegetables? What is the cost of non-veg items? What will be the cost of other items, milk, etc. So that must be expressed in quantitative terms. It is the pre-planned activities that must be expressed in quantitative terms. So simply we can say a financial plan and a list of all planned expenses and revenues. Budget is a financial plan and a list of all planned expenses and revenues. Okay. So these are the various types of budget we can say. Budget sectors are also there. Various sector of budget, sectoral budgets are there. For startup, you can go for startup budget. Let's say you want to start a new company or new enterprise. For that also you have to plan for a budget. Again, corporate or business budget, government budget. So what is government budget? What is government budget? Can you tell me? Any idea? In each and every before the financial year, starting of the financial year, in the both the houses of the parliament, the government also pass one general budget. Okay, so here it will plan what are the sources of revenue and what are the various sector where the government is going to expense out, or where the government is going to invest, where 1 rupee can come and where 1 rupee can be spent. Okay, so government budget is there. Event management budget, let's say for your marriage ceremony, for your what you can say birthday ceremony, for any other ceremony, if you are planning, this is one of the event. For each and every event you have to also uh, prepare one budget. Again, personal and family budget, I have already cited the example. For your family, at the end of each and every month you are planning for a budget about your food, about the clothing, about the shelter, etc. So these are the various budget sectors. Again, what are the various types of budget? Budget may be classified into various types on the basis of flexibility, on the basis of time period, and on the basis of functionality also. On the basis of flexibility, it may be fixed budget and variable budget. Fixed means constant. What are the estimates you are making? That means you cannot deviate that. You have to follow that. You have to follow that. Let's say you are preparing a budget relating to food, clothing, shelter. Food 5,000, clothing 2,000, shelter 3,000. So total amount of budget is 10,000. So you cannot change. You cannot change. That is fixed. You have to spend within that. That is the fixed budget. Another one is the variable budget. Variable budget means which can be changed, which can be vary whenever you are going to execute the budget. Okay, so here the same example I can cite. You have already planned for 3,000 for your fooding, sorry, 5,000 for fooding, 3,000 for clothing, or 2,000 for shelter. So you can change. Let's say you're fooding about 2 or 3 guests, or 2-3 times in your family some guests came. So what you will do? Automatically your fooding expenses will increase. So as a result, your what you can say fooding item, that means the amount of fooding expenses will increase from 5,000. It can also increase to 7,000 or 8,000, like that. That means it can change, it can vary. So on the basis of flexibility, we can say there are two types of budget. One is fixed budget and another is variable budget. But on the basis of time period, we can say there may be certain budget, there may be long-term budget. What is certain budget? When we are planning for our budget for a period of 1 year or 1 to 3 years, we can say it is certain budget. But whenever you are planning for a period of 10 years, 20 years, 30 years, like that, it is known as long-term budget. Again, on the basis of various functions also, there are so many types of budget. What are the various functions performed by the business? Sales is there, production is there, marketing is there. Okay, so these are the various functions of the business. So on the basis of the various functions, there may be various types of budget, like your sales budget, production budget, marketing budget, project budget, revenue budget, cash budget, etc. So these are the various types of budget. Okay, so let us discuss about what is capital budgeting. So capital budgeting consists of two words. One is your capital, second one is your budgeting. So budgeting is determined from the word budget. Monalin Harichandan asking something. Just a minute. Sir, can Can you please give example of time period budget? Time period budget means what? On the basis of time period, either it may be short-term budget or it may be long-term budget. Let's say you are planning for a budget for a period of 1 year. Simply you can say it is a short-term budget. If you are planning for a budget for a longer period, for a period of 10 years, 20 years, that is long-term budget. That is long-term budget. Let's say you are planning for your sales or production. So your production will be for 3 months, or it may be for 6 months, or it may be for a period of 1 year. So here we can say production budget is the short-term budget. But let's say you are going to construct a particular what you can say particular plant. Okay, so for construction of plant, what do you need? You need longer period of time. So you may spend your money for a period of 5 years or 10 years. So after spending your money, you can able to construct your plant. So after construction of plant, you can able to generate the revenue for a longer period, for a period of another 10 years or 20 years. That may be the long-term budget. Okay, so on the basis of time period, it may be short-term budget or it may be long-term budget. Okay, so next let us discuss about the capital budgeting. So whenever we are talking about capital, as I have already delivered to you, capital means what? It involves large amount of fund. So why we spend, or why we are allocating large amount of fund? The reason is very simple. In order to increase the revenue of the fund. In order to increase the revenue of the fund. So capitals, whenever we are talking about capital, simply you can say operating assets used for production. So for production, what do you need? You need plant, you need machinery, you need human resources, isn't it? You need raw materials. Okay, so these are your capital. This involves large amount of fund. This is capital. Then budget we have already discussed. It is a pre-planned activities which is expressed in quantitative terms. So we can say a plan that details projected cash flows during some period. Whenever you are investing today some amount, so in how many years you are going to receive or going to get the bundle of benefits. Today you are spending, let's say, 100 crores in any project. So you are spending 100 crores. What is your objective? Your objective is to get periodic cash flows. Periodic cash flows. So in how many years? At the end of the first year, what will be the cash flow? At the end of the second year, what will be the cash flow? That means inflow. At the end of the third year, what will be the cash inflow? Expected cash inflows. So whenever we are talking about budget, we can say a plan that details projected cash flows during some period, during a series of years. Then what is capital budgeting? Capital budgeting is the process, or we can say it is a method for analyzing projects and deciding which one to include in capital budget. Which one to include in capital budget? So very simple example I want to cite here. Let's say Reliance Industries Limited wants to install a plant in the state of Odisha. So it has already decided that it is going to invest 5,000 crores. So in order to install the plant in Odisha, Reliance Industries Limited has already decided that it will invest 5,000 crores. This 5,000 crores is the capital amount that is going to be invested by Reliance Industries Limited. What is the objective of Reliance Industries Limited? So its main objective is to get the periodic cash flows. If it will invest 5,000 crores in the state of Odisha in a particular place, what will be the cash flows over the series of years? In how many years it can able to recover that 5,000 crores or more than that, not less than that, because this is the fundamental concept of the business. So whenever we are talking about capital budgeting, try to remember it is the process or it is the method to which we can analyze the project. So whenever we are analyzing the project, what we are looking? We are looking what will be the cost and what will be the bundle of benefits or series of benefits we are going to get. Let's say 3 or 4 alternatives are there. Out of 3 or 4 alternatives, you have to choose any one. You have to choose any one. So whenever you are choosing any one, how you can choose that this project will be suitable for me? You can go for cost and benefit analysis. So in capital budgeting, we can say it is the method of analyzing the project by taking the cost and benefit factors and deciding which ones to include in the capital budget decision. On the basis of that, you can decide which project you are going to take. Okay, so this is the capital budgeting. Someone is asking, kindly again explain time value of money for which reason that today's money is more than future money. Okay, once again I am explaining. You are asking about what? For which reason that today's money is more than the future money. Look here. Can you get your name? Can you tell your name? What is your name? Jairam Jana. Okay. 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 I am explaining. So you are asking that why today's money is not equal with the future money. So what are the factors actually there? Here I want to cite one example. I want to ask one question to you, Mr. Jairam Jana sir. Can you tell me before 10 years what was the petrol price per liter and what is the petrol price per liter today? Can you tell me? Before 10 years, let's say per liter petrol price was 60 rupees. Let's say. Now the petrol liter per liter petrol price is 100 rupees. That means before 10 years you are getting the same 1 liter petrol. Today you are also getting the same 1 liter petrol. What is difference? Difference is the price. Why? Why? Why there is the difference in price? Because of so many factors. What are so many factors? Inflation is also there. Inflation is also there. Yes or no? So because of the inflation, what do you mean by inflation? Simply you can say this is the rising of the prices of the commodities and the services. When the commodity prices will increase, automatically what will increase? We are getting the same quantity, but the price is different. Price is different. Okay. So here we can say inflation is one of the reason. That's why we need to consider time value of money factor. Another reason is that your current consumption. What happens as an individual investor, you are sacrificing your current consumption. Let's say I am citing my example. My example is that let's say I am earning 60,000 per month and my spending is 40,000 per month. My expenditure is 40,000 per month and my income is 60,000 per month. So what is the surplus or what is the savings? Savings is 40,000, sorry, 20,000, isn't it? So 20,000 is my savings. So that savings I am keeping, I am saving to invest in anywhere else. I can keep it in fixed deposit. I can also invest in share market or stock market. I can also invest in any other investment avenues. Isn't it? So here what I am doing actually, I am sacrificing my current consumption. If I will not invest that 20,000 in any investment avenues, I can live a luxury life. That 20,000 I can spend to live in a luxury or to live in a comfort. So here I am sacrificing my current consumption. Why I am sacrificing my current consumption? In order to get more amount of return. So that 20,000 if I will invest today, what is my expectation? My expectation is that in future I am going to get more than 20,000, not less than 20,000. Isn't it? Hi or nahi? So these are the reasons. That's why we need to consider time value of money. Time value of money. If you have 1,000 today, you can put your 1,000 in your pocket. You can put that 1,000 in any commercial bank as a fixed deposit. If you are putting in fixed deposit, let's say fixed deposit rate is 10%. So at the end of the year, you will receive 1,000 plus 10% of 1,000. That means 1,100. If you are putting that money in your pocket today, up to a period of 1 year, you will get only 1,000. And sometimes there may be the chance that you can lose your money. You can lose your money. Yes or no? So that's why we need to consider the time value money factor. Try to remember where the money passes through the time, its value will increase. Its value will not decrease. What you are going to get in future, The value of that amount is not same as today. So today you are investing 1000, you are putting 1000 in any fixed deposit, in the form of fixed deposit. So after you are getting 1100. That means 1100 is your future value. What is the present value? 1000 is your present value. So we can say that 1100 what you are going to receive after 1 year, the present value, the value of 1000 today is same with that, because in order to get 1100 you have to wait for another 1 year, isn't it? That's why we need to consider the time value of money. In case of a company also, if the Reliance Industries Limited, as I have cited one example, if the Reliance Industries Limited is going to invest 5000 crores today, it will receive some cash in the future. Whatever the cash it will receive in the future, the same amount of cash, that means the cash, future cash flows may not be equal with the present value of the money today. So that's why what we'll do, we have to discount with some present value factor, in order to get the present value of money. Okay, so this is all about your time value money concept. Chalo. So is it clear? Thanks, are clear. Okay, thank you so much, Mr. Jairam Babu. So we are discussing about capital budgeting. Okay, why capital budgeting decision is important for a firm? Why capital budgeting decision is important for a firm? Try to remember, capital budgeting decision is very much relevant for a firm for the purpose of growth, expansion and modernization. For the growth of the firm, expansion of the firm, expansion means, let's say currently you are doing 200 crores business, you want to expand your business, that means 200 crores to 500 crores. So here you are going to invest another 300 crores in order to increase the size of your business. That is the growth or expansion, you can say. Again, modernization, what are the technology or what are the methods you are using today? You want to use the high-tech methods, latest technology methods. So for that you need to invest some amount, that is the modernization. So for the purpose of growth, expansion and modernization, there must be need of capital budgeting decision. That's why it is very much relevant. Okay, again, large amount. So in case of capital budgeting decision, it involves large amount of fund. There is the commitment of large amount of fund. So it is not like your 1000, 2000, 50,000, 1 lakh, like that. In case of FAR, the fund may be 200 crores, 500 crores, 5,000 crores, 10,000 crores. Is this amount small? Simply you can say this amount consists of large amount of funds. That's why it is very much important. If you will take one wrong decision, then you will lose like anything. Loss will be huge. So whenever we are taking the capital budgeting decision, since it commits large amount of fund, the decision should be taken judiciously. Again, irreversibility in nature. Capital budgeting decisions are irreversible in nature, not reversible. Once you take the decision, you can't get back. If you will get back to your decision, then you will incur substantial loss. Try to remember. You incur substantial loss. Take the example of POSCO in Odisha. POSCO has already make its feasibility study or project study. After its feasibility study, it has decided that it is going to implement a plant near Paradip at Odisha. So what is the amount of fund? Amount of fund is 10,000 crores. But what is the scenario now? Due to public interference, what happens? It could not able to succeed. So it has already constructed some buildings. It has already installed some plants, some machineries. Just tell me, can it take back now all the machineries, all the constructions, what it has already made? The answer is no. So capital budgeting decisions are irreversible in nature. If it is reversible, then the firm has to incur substantial loss. Next one is complexity. Complexity means what? Capital budgeting decision involves complex procedure, not simple procedure. It involves various steps. Various steps. That means project identification or project generation, then project selection, project execution, then follow up. Various stages are there. So whenever you are taking the capital budgeting decision, since it involves series of process, it is complex in nature, not simple in nature. Again, risk is also more in case of capital budgeting investment decision, since it involves large amount of fund, so the risk of the firm is also more. Again, long-term implications are there. Long-term implications means whenever you are taking capital budgeting decision, you can able to get some amount or some gain in long term, not in short term. Today you may invest 1,000 crore or 5,000 crores. So immediately you cannot get back that 1,000 crores or 5,000 crores. So in order to get back that 1,000 crores or 5,000 crores, you have to wait for some period. You can get within a period of 5 years or within a period of 10 years, within a period of 15 years. That's why capital budgeting decisions have some long-term implications. Then what are the benefits of capital budgeting decision? Estimation of cash flow. We can able to estimate the cash flow. If you are investing some amount today, what are the amount you are going to get in the near future over a series of years? You can able to estimate. So estimation of cash flow is there. That is one of the benefit of capital budgeting decision. Forecasting return. You can able to forecast. You can able to predict your return. How much return you are going to earn in the near future. Again, risk and uncertainties. You can able to measure what is the degree of risk involved in capital budgeting decision. Okay, so these all are benefits of capital budgeting decision. Is it clear? Did you understand, everyone? Someone is asking, sir, during capital budgeting, revenue generation a part of that? Yes. Let's say today you are starting your project. So out of the 100%, let's say 20% or 40% of the project you have completed. So immediately you can start some of the production, less amount of production, so you can able to earn the revenue also. Okay. So next class we will continue with the same. So we have already crossed the time limit. So thank you so much for joining with me. Have a good day. Stay safe and stay blessed. Thank you all.